Hello and welcome back to my 10 favorite people. Hope you're doing well. I'm incredibly excited for today's video because we've been trying to narrow down what type of cycle Bitcoin was going to have for quite a while now. And I believe we finally got our answer yesterday in the economic projections that the Fed released. And the great thing about how these projections are laid out is we can see the March projection for each data point right below the one we received yesterday, so we don't have to go back and forth between two documents. And of course, the big one that is the most eye-catching is the change in the expected Fed funds rate by end of year. In March, they told us they were expecting to cut rates 3 times by the end of 2024. That is now only once. And of course, this is quite hawkish because the other central banks are already starting their rate cuts, whether it's the ECB or the Bank of Canada. I think the Bank of Japan will be joining them soon. And when you combine dovish central banks around the globe with a hawkish Fed, you end up with a strong dollar. And this chart looks like it wants to go higher. It's been higher lows for quite a while now. And we know that a strong dollar is not good for Bitcoin. In my last video, we talked about how if we were going to have a mania phase, we needed to see the dollar going down aggressively, and that's what would be required for the left translated cycle to play out in the short term. We would really need to see the dollar roll over aggressively here. But if the Fed is taking this hawkish stance and telling us they're going to keep rates higher for longer until inflation goes significantly lower, or until something breaks in the economy, like the unemployment rate spiking back up, that likely means it's going to be a while before the Fed cuts rates. And as long as those other central banks are cutting rates, that's going to put upward pressure on the dollar, which of course puts downward pressure on Bitcoin. And that makes a lot of sense because Bitcoin's main narrative is a debasement hedge. But if the currency is not necessarily being aggressively debased and it is instead strengthening, that's not going to be the backdrop Bitcoin needs for these huge parabolas. And that's why we monitor the dollar so closely, because it's the purest representation of the Fed's monetary policy against the other central banks that are in the basket that makes up the US dollar index, mostly the euro, but then the Japanese yen, Great British pound, Canadian dollar as well. And all of those economies are quite weaker than the US's economy. So they're going to be a lot more dovish than the US is, which is going to put downward pressure on risk assets as long as the Fed keeps rates higher for longer. Now, if we are going to have a normal cycle with a longer consolidation and reaccumulation period, I think it's incredibly valuable to talk about some possible outcomes and where perhaps Bitcoin could find its bottom this summer, not so that we can sell our entire portfolio for cash and buy back in at lower prices, or open a 20x leverage short and try to get rich by shorting Bitcoin here and then closing at one of these support levels. It's more so that we can be prepared for multiple outcomes, because the most mistakes in this market are made when somebody is blindsided by a scenario that their favorite influencer told them was impossible, or that they did not see coming whatsoever and were blindsided by. And I think volatility is definitely something we're going to have to be prepared for, because essentially the Fed told us they're not going to cut rates until something breaks, and the most likely thing to break will be the unemployment rate. It's been trending up quite a bit recently, and every time it's gotten above this 2-year moving average in yellow, it has spiked up quite soon after that, within a month or two max. And then obviously inflation prints are going to have a huge impact on markets as well. CPI has been quite stubborn above 3% for a while now. And if we look at the forecast from the Cleveland Fed for what's going to be roughly the June CPI number, it's going to be 3.1 or 3.2, which is still above 3% and still too high for the Fed to cut rates. So the Fed is not going to cut rates because inflation is coming down and because they want to. It's way more likely they're going to cut rates because they have to, because something is going to break in the economy. Now, funny enough, they might actually be able to avoid the technical definition of recession by keeping GDP high. We know the definition of a recession technically is a fall in GDP for 2 successive quarters. But if we take a look at the GDP forecast, we see their forecast for end of year is 2.1, and for 2025 it's 2, and 2026 is 2 as well. And this isn't because, they're just being hopeful and ignoring the facts. It's because when you're running huge national deficits, I mean, right now for fiscal year 2024, which started in October 2023 and ends in October 2024, we're already in a $1.2 trillion deficit in terms of what the federal government is spending versus what it's making. And we're on pace to hit $2 trillion by the end of this fiscal year. So it's pretty easy to keep GDP elevated and above that 2% number and well above that 0% recession number. And I think that's what they're going to continue to do via these deficits. But the unemployment rate going up might still force their hand. I don't know when that's going to occur. Obviously, that's a hard thing to track accurately on a short-term basis, but the trend is definitely very obvious. And I think it's only uphill from here, unfortunately. So we know we need to survive some pretty serious volatility most likely, and these are the levels I'm watching personally. I have them labeled for how likely I think it is that Bitcoin goes there, and I didn't just make up these levels. These are just crucial support and resistance levels from Bitcoin's history. This 57 to 59 region was major resistance in 2021. We tested it as support recently. If we came back down to it and built some bigger accumulation structure, it could hold if maybe things don't get too bad before the Fed starts easing their policy. But I'm personally way more interested in this green region here. It was our last consolidation before the all-time high break. It was also major resistance and support in 2021. And it's the first level where I would start to seriously consider adding to my exposure and maybe deploying some of the cash that I've kept on the sidelines for a while now. And then after that, things start to get quite unlikely. This is kind of my line in the sand. Something really bad would have to happen for us to get below this level. In my opinion, this is essentially the macro mid-level of Bitcoin's entire past 4 years, essentially. It's also where the ETFs went live, and I do think the ETFs have changed Bitcoin as an asset in terms of regulatory clarity, in terms of institutions having the ability to get exposure. I do think Bitcoin is very different pre and post ETF, and this 40K-ish region where we launched the ETFs is likely going to be major support. I don't even think we get there, but if we do, I don't think we go below it, and that's why I have this area below this major accumulation phase during the bear market as very unlikely. Again, anything is possible with massive black swans, but this is not my base case that we get this low or even this low. I would really expect huge buyers to step in this region if we were to get below this one. And those are my general thoughts on where I think Bitcoin will bottom, and we'll definitely monitor these support levels as we start to see that rise in the dollar index, because that likely puts downward pressure on Bitcoin and maybe pushes it towards some of these levels. But of course, this market does what it wants, and maybe on the next test of the 20-week moving average, we just recover and go higher because the Fed decides to cut rates for some reason, or maybe the Ethereum ETF ends up being a huge hit. So I'm not willing to go all in and bet we hit these levels, which is why I maintain my 80% spot exposure. Actually, it's probably less than this now that prices have gone down. Maybe it's 78% or something. I got tired of updating this for every single video because it doesn't shift that much, maybe 1 or 2% here and there, depending on what the market is doing. But these are the levels I'm watching if we're going to have this normal cycle thesis play out after all. And after what we saw from the Fed yesterday and the current projections, they made it very clear they're not cutting rates until inflation is 2%. Or there's a spike in the unemployment rate. And it might seem like they're delusional putting 4% here as their end of year unemployment rate target, even though the unemployment rate is already at 4%. But that's actually by design, because if they were to put 4.2 or 4.4% on here, Powell would probably get dragged in front of Congress and asked why you guys are keeping rates elevated even though you think the unemployment rate is going to keep going up. So by them putting 4% here, they can pretend that they don't think unemployment is going to go up anymore. And if it were to go above 4%, they could say that was a surprise that caught them off guard. And if unemployment rate goes above their end of year target, maybe the Fed funds rate could go below their end of year target and they would have an excuse to cut rates sooner. So unemployment rate prints are going to be very crucial going forward. Of course, we only get one each month, so it's not something that happens too often, but I expect markets to react to them quite a bit, perhaps even more than inflation readings, because we're not expecting that much movement in CPI over the next few months. It's most likely just going to stay between 3 and 3.5% for a while. But of course, monitoring the dollar index will give us a great indication of how hawkish the Fed is being compared to the other central banks. And of course, we'll always continue to monitor the Fed funds rate expectations. Right now, the market is kind of calling the Fed's bluff and pricing in 2 rate cuts for 2024, even though the Fed said they only foresee doing 1, but that's because the market probably thinks the unemployment rate is going to go well above 4% and the Fed is going to be forced to cut rates sooner, which is why the market is pricing in 2 rate cuts, even though the Fed just told us yesterday they only think they're going to be doing 1. And although Bitcoin is significantly more monetary policy driven because it doesn't have earnings or anything and its main driver is being a monetary debasement hedge, it tends to react a lot more to the dollar index than the S&P 500 does. The S&P 500 still looks like it wants to go higher, probably because GDP is still remaining positive thanks to the deficits being run by the federal government. And that's kind of the backdrop we want to see. We want to see a strong S&P 500 if something further out on the risk curve like Bitcoin is going to do well. But of course, Bitcoin is just going to react more to what we're seeing from the Fed and what we're seeing from the dollar. But as of right now, doesn't look great. We just keep getting sellers stepping in every time Bitcoin gets above 69,000, but we still have a few days until the weekly close, so we'll have to wait and see what happens there. As for Ethereum, had that huge candle on the rumor flip on the ETF approval, came down and tested the mid-level of that huge candle. And I did see something today about the Ethereum ETF definitely going live sometime this summer. So I do think Ethereum will do relatively decently as long as that Ethereum narrative of the ETF going live is in play. But of course, we're going to have to see what those inflows are like to decide the trend over the next few months or so. And we see something similar from Solana. It had that nice rally alongside Ethereum and now is coming down and retesting its 20-week moving average and trying to hold on for its life. Even with all the celebrity meme coin speculation, Solana has still been struggling recently. And although it's been putting in lower highs, it's been putting in higher lows as well. So we are approaching the moment of truth on Solana. But based on how Bitcoin dominance looks, it looks like altcoins are going to underperform Bitcoin in the near term, especially if we're going to see a prolonged sell-off alongside this normal cycle trajectory, because Bitcoin correcting to any of the levels I have listed here is most likely going to put huge upward pressure on Bitcoin dominance because altcoins are likely going to correct more. And I'm okay holding that downward volatility on Ethereum and Solana because I have pretty high conviction they'll survive whatever downside we get into. But I would be a lot more concerned if I was holding newer, riskier alts that were a lot less established and had less liquidity. But of course, we'll have to see what happens there in terms of Bitcoin dominance and the altcoin market as a whole. But of course, a lot of this is just preparation for the medium term and whatever consolidation, downside, and reaccumulation we end up seeing. But in the longer term, currency debasement isn't going anywhere and Bitcoin is likely going to continue its upward trajectory against fiat currencies, just like we've seen with the S&P 500 over the past 100 years or so. Yes, there's black swans. Yes, there's huge shakeouts. But as long as they're devaluing the currency that we're pricing these risk assets in, as you can see by the huge expansion in money supply and national debt over the past few decades, it's likely that our risk assets like the S&P 500 and Bitcoin will continue to go up in the longer term. We just need to survive the volatility and emotions in the short term. But anyway, let me know what you expect. How low could Bitcoin go between now and the end of 2024? Would love to know what you guys think. Thank you so much for the support on the recent videos. Thank you so much for watching, and I'll talk to you soon.